Here's a look at how Zimbabwe's market has fared for the day. The Zim mining index down by just around 0.1%, 71 on the day is where it closed. Industrial index, we also saw a bit of a drop off there, but pretty much flat, one might say. 189 points overall, though. That index is up 5.7% on the week. So a nice gain, almost 6% gain, in fact, for Zimbabwe's market. Let's drill into all of this. We've got any more Taruvinga equities analyst at Kingdom Financial Holdings standing by on the line. Any more, thanks for joining us. So looking at the gainers this week, FAL Gold up 40%, RTG up 18%, and ZBH a 16% gain. So talk to us firstly about FAL Gold. I mean, 40% rise to 14 cents is certainly a strong rally. Do you think that this can be sustained?
Well, with FAL Gold, it's a mining counter. We've seen some positive news coming through, especially on the mining sector. We recently saw an article from African Development Bank actually indicating that going forward, the economy of Zimbabwe is going to be driven by the mining sector, with exports expected to increase to about 5 billion from that sector alone. And FAL Gold is into gold production, which is a major export mineral for the country. Last year, we saw its volumes actually increasing by about 60%. And I think investors are expecting that production to also significantly go up this year, hence the increment in the price. As for sustainability of the price, I think last year we saw it hitting around 16%, its highest. So at 14 cents, I think there's still some movement gap that can be taken. That can also happen on that counter. So there's still some room for movement on that counter.
I mean, you know, even if we have had the gold price, which is, you know, stronger this week, and we did see a nice recovery yesterday, is FAL Gold still profitable at just around the $1,400 per ounce mark?
Yes, definitely it is. The cost per ounce in Zimbabwe is around $800 to $900 per ounce. So at the price of 1.4, there's still a big margin to be taken in that price.
Let's talk about RTG before we move on to some of the fallers on the week. RTG up 18%. What do you see sparking interest in this specific counter right now?
Well, RTG is one of those speculative counters in the tourism sector. Recently there were some management changes at that group, which we think is going to lead to a strategic change in that counter. Previously, it was making losses as a result of huge debts, but they recently had the rights issue, which was successfully underwritten. So we expect that the money that they raised from that rights issue will settle some of that debt that they've been struggling with. Also, total occupancies in the country have been going up from around 37% last year. We expect them to go to about 44% this year. And the fact that the country is going to host that UN General Tourism Assembly this year is also going to post some positives on the sector in the country.
So some speculative buying on the back of that. On Tuesday, the ZSE said goodbye to 3 stocks, delisting 3 of them, Barbican, TZI and Red Star. They had been, of course, on suspension for more than a year. So what is a signal does this send to the investment community?
Well, the move has got both positive and negative sentiments. On the negative side, we are saying now the market is thinner, 3 counters down from about 79. We have got now 76 counters. But on the positive side, we are seeing this as a good signaling item to some of the counters that have been actually suspended for some time, because we found that more and more of the counters were going under suspension, and the prospects of them coming back to trade were actually very thin. As we speak, we have got still another 6 counters that are suspended on the ZSE. And in terms of progress towards lifting of that suspension, it has not been forthcoming. So we think by taking this move, the ZSE is actually signaling to those companies that they better improve on their prospects. Otherwise, they also end up being delisted.
And Huangwe is looking to restructure its JV with the Chinese firm, and that, of course, has been a strained relationship. Do you think they'll still be able to pull off this deal where, of course, the Chinese partners bring in the money and build, ultimately, the coke oven battery for Huangwe, and Huangwe provides the coke and coal?
Yes, the build or operating transfer deal was actually consummated. But what Huangwe is now trying to do is to increase its share of that venture. At the moment, they've got a 25% stake in that venture, but they actually want to take that percentage up to a controlling stake, at least 51%. I think it's in line with the indigenization requirements, and also the fact that the gas product is actually receiving positive demand in the country owing to the power challenges. I think Hwange is trying to strategically position itself to take advantage of the developments in the energy market local-wise.